Let's talk about one ETF that has caught my attention recently. I know the YieldMax name usually brings mixed emotions. Some of their funds have struggled with NAV erosion, others have built a strong following. But nobody seems to be talking about this fund and how it has been performing. It's built around a sector that's become the backbone of the modern economy, semiconductors. And in most people's view, semiconductors are the new oil. Everything from AI, cloud computing, electric vehicles, defense, data centers, all of it runs on chips. Without them, nothing in the modern economy works. And that's what makes this fund interesting. The YieldMax fund I'm discussing is CHPY, or CHPY. I want to clarify that I don't currently own this fund or any other YieldMax ETF, but I do have to give credit where it's due. The fund holds a diversified basket of semiconductor stocks, roughly 20 to 30 of them, including names like Nvidia, AMD, Broadcom, TSMC, and others. Then it sells covered calls on that portfolio. Correct me if I'm wrong, but I believe it actually holds these stocks, not synthetics. It's harvesting volatility, getting paid when these names swing up or down. Those premiums become income distributed weekly to shareholders. So while the sector moves through wild cycles, CHPY converts that chaos into consistent cash flow. You're not getting the full upside of a pure semiconductor ETF like SOXX or SMH, but you're also not just sitting there waiting for the next rally. You're monetizing the volatility that everyone else fears. At least that's what's being advertised. Here's how I look at it. Semiconductors will always be cyclical, but they're also structurally indispensable. Over the long term, demand is only heading one way, higher. AI servers need thousands of chips. Electric cars need hundreds. Even data infrastructure, smartphones, and industrial automation all rely on advanced semiconductors. So, rather than trying to predict when the next chip boom happens, CHPY lets you earn income every week while you wait. It's a smart way to stay exposed to one of the most important industries in the world, and still collect steady yield while the market sorts itself out. In other words, you're getting paid to hold the new oil. Now, let's get into the numbers, because that's what really matters. Since April 2nd, 2025, CHPY has delivered a total return of about 59.45%. Over the same period, the iShares Semiconductor ETF, SOXX, is up around 61.90%, and SMH, the VanEck Semiconductor ETF, is up roughly 67.92%. Honestly, CHPY is tracking these semiconductor ETFs surprisingly well. It's a few percentage points behind, but it's certainly not performing as poorly as you might expect from a YieldMax fund. This isn't a fund for everyone. If your goal is maximum capital growth and you're comfortable with high volatility, SOXX or SMH might still be better fits. But if you like the semiconductor story, and if you believe in AI chips and the entire digital infrastructure movement, yet you also want regular income without selling shares, CHPY might have a spot in your portfolio. Obviously, if you've lost confidence in YieldMax's management as a whole, that's perfectly fair. You don't need to touch this fund. But I want to highlight it because, performance-wise, there are actually some encouraging signs. In fact, I'd argue the team at YieldMax could learn a few lessons from how this ETF is structured and managed. This is one of the more well-executed products they've put out so far. I also had a hard time finding another semiconductor ETF that offers high weekly distributions while keeping up with the total return performance of similar semiconductor ETFs. If you know of one that does, drop it in the comments. I'd really like to check it out. Of course, CHPY is not perfect. If semiconductors enter a full-blown bear market, CHPY will fall with them. The upside is capped, so when Nvidia or Taiwan Semi go on a huge run, CHPY will most likely lag. But again, for investors who want exposure to the semiconductor story and steady income, it's one of the few ETFs that combines both. Personally, I like the idea behind CHPY because it takes a logical approach to a difficult problem, which is how investors can stay invested in an overvalued, momentum-driven sector without constantly worrying about timing. Instead of trying to buy the dips or predict earnings, it pays you to wait. I also like that it spreads risk across multiple semiconductor names instead of betting everything on Nvidia. And while it caps your upside, it still lets you participate in the long-term growth of a trillion-dollar industry, one that powers everything from AI chips to quantum computing. If semiconductors are truly the new oil, then CHPY is a clever way to own the refineries, the places where that value gets extracted and turned into cash flow. It's not a perfect ETF, but it's a practical one. For me, this would fit in the income sleeve of a portfolio maybe a small allocation. Because at the end of the day, investing is about balance, growth on one side, income on the other. And CHPY, in my opinion, strikes that balance surprisingly well for a sector known more for hype than stability. I'll be honest, I'd really like to see YieldMax experiment a bit more with their strategy. Right now, most of their ETFs are fully covered call structures, which means the income looks great on paper, but the upside gets capped almost immediately. It would be interesting to see them test a partial covered call model, maybe around 50% coverage, so investors can still capture some of that growth when names like Nvidia or Broadcom take off. I'd also like to see more transparency in how each fund's performance breaks down between actual option income and capital erosion. If investors could clearly see how much of their yield is coming from sustainable income versus just the fund losing value, I think it would help rebuild confidence in the brand overall. YieldMax has the right idea, turning single stock volatility into income, but they need to fine-tune it. A bit less aggression on the calls, a bit more balance, and these funds could actually become long-term income tools rather than short-term trading products. Personally, I am watching CHPY closely, but I haven't added it to my portfolio just yet. I like the concept, getting paid weekly to hold a basket of some of the strongest semiconductor names on the market, but I want to see how it behaves through a full market cycle, especially if we see a slowdown or correction in the semiconductor space. Right now, I see CHPY as one of the more promising YieldMax ETFs, probably their best execution so far, but I'm cautious. If it can maintain distributions and manage volatility without significant NAV erosion, I'll seriously consider it as a small income position. Until then, it's on my watch list. At the end of the day, the goal isn't just to collect yield, it's to build wealth that grows and compounds over time. CHPY might fit that puzzle, but we need more data before making it a core piece. If you got value from this breakdown, make sure to like, subscribe, and turn on notifications so you don't miss future deep dives like this one. And I'd love to hear from you in the comments. What are your thoughts on CHPY? Do you own it? And how has your experience been so far? Thanks for watching, and I'll see you in the next one.